Hello and welcome everyone to my channel, The Quality Investor. Earnings season kicks off this week in earnest. There were some big names on the docket this week, headlined by Dow members JP Morgan Chase, ticker JPM, and United Health Group, ticker UNH. In the next few weeks, our holdings could see some pretty large price swings as the earnings are released. Either way, we should be happy as quality investors because we own a collection of quality businesses. A downswing could mean our holdings can go on sale, and an upswing means our investments are doing their job and growing. The caveat, of course, is that the underlying reason we own the business or the investment thesis remains intact so long as the core fundamentals of our businesses don't experience a negative paradigm shift. There is no reason to sell. When we buy our small slices of a business, it's because we believe that it's high quality by nature, yet the market is undervaluing it by a significant margin. This brings me to the thrust of this video: intrinsic business value. We buy investments because we believe the intrinsic value of that business is a good deal higher than its current sticker price. If we believe a business is worth $100 a share and the market is currently offering us $80 per share, we're buying that business. Before we continue, if you enjoy content like this, please hit that notification bell and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. This sounds easy, but it is quite difficult in practice to discover the true intrinsic value of a business. Warren Buffett plainly says, to determine intrinsic business value of an asset, simply take the present value of the net cash flows from here to eternity based on the current bond rates. Sounds easy, right? Put another way, net cash flows is the free cash flow, eternity is a 10-year span, and current bond rates is a discount rate. While anybody can perform a discounted cash flow analysis, the actual intrinsic value of a business is much, much more than an Excel spreadsheet. If it was that easy to apply a 12% free cash flow rate for the next 10 years and discount it back at 10%, there would be dozens, maybe hundreds of businesses that would be trading 20 to 50% below their current share price. We would all be making money hand over fist, but we're not. Are any of those businesses really worth what our computer says? Absolutely not. Intrinsic value, then, is much more nuanced, much more of an art that takes years to master. And even then, as the greats would be the first to tell you, they haven't mastered anything. This video was inspired by a comment on my 3 stocks to buy for 2024 video I did a few weeks ago. I said Costco was a good buy despite trading at a 40 plus PE ratio at the time. The commenter called me out and said a multiple that high means it's become too expensive. And the commenter is right. Costco trades at an absurdly high multiple and is very much in the overvalued territory. Most businesses that reach that level are way overpriced in the market. Paying over $40 for $1 of earnings is crazy. However, I believe Costco is still undervalued in the market. Their intrinsic business value is so much more than their current earnings. And that is very difficult to quantify in a tidy discounted cash flow model. This is where the nuance comes in. This is where a deep understanding of the current business model and where the future economics of a business comes in. This is where the quality of management comes in. Many businesses trade at low PEs or spit out mouth-watering cash flow projections. And more often than not, the numbers we use will all be wrong. That's why it's so difficult to determine intrinsic value. We are making predictions, which humans are notoriously bad at, and basing decisions on numbers on a screen. What we want to find is businesses that have a high and growing intrinsic value relative to the current market value. The 3 most important factors in assessing that are: number 1, quality of business model; number 2, quality of management; and number 3, future economics for growth. Very few businesses are top-notch in all 3. Our job is to assess businesses against these 3 factors and come to an obvious conclusion that the business is best in class in each one. The business model should be simple over complex, easy to understand by anybody, and by its nature, print money. Visa collects a fee every time a person swipes their credit or debit card. Adobe, Microsoft, and United Health Group collect subscription revenue, although Health United calls them premiums. Costco is membership-based. Customers pay Costco for the privilege to shop in a Costco warehouse. Once inside a Costco warehouse, its design plays on human psychology, which means consumers ultimately buy way more than they need. Once a graphic designer learns Adobe, they will always use Adobe. The switching costs are too cumbersome to overcome. These are examples of simple business models that anyone can understand, but not duplicate, more on that later, and that print money. The quality of management is the next factor. This is harder to assess as human beings tend to be mercurial, at least in the aggregate. And any business will have a cadre of executives competing internally for clout and power, as well as making decisions that make or break fortunes for thousands of employees and investors. Management must be top-notch. It must be ethical and honest. It must be able to identify new economic opportunities without sacrificing the core business. It must make tough decisions and stand by them. It must know when to cut losses early and allocate more resources to promising ventures. There are many other facets of management that make it great. Very few businesses possess all these qualities in management. Management's ability to effectively allocate capital is what drives shareholder returns over the long term. The better they allocate to high return ventures while keeping the cost of that capital low, the better the returns. If management must make substantial investments year after year to simply stay at the same competitive level, in other words, high cash inputs with no growth, returns will suffer. The best way to quantify this is with return on invested capital and return on capital employed. Seek out businesses with a high ROC and low capital expenditures. Over the last 5 years, MSCI has over 22% ROC and spends about 8% of its net income on CapEx. We apply the adage, past behavior predicts future behavior when it comes to individuals. However, investors love the adage, past returns are not indicative of future returns when it comes to businesses. That seems contradictory to me, and I will go with past behavior every time. What is a business if it is not a collection of individuals? Finally, what are the future economics of a business? This is the most difficult question to answer because it is nothing more than a guess, a prediction. Humanity's track record of prediction is abysmal. Go back and find predictions made in the 1970s and 80s about the early 21st century, and they're laughable. Back to the Future is actually a pretty fun watch in this regard. So, how are we to assess what the future of a business is? Growth rates are, whatever. Just be conservative and call it a day. You'll be wrong anyways. I use an 8% discount rate for all my discounted cash flow models. For growth rates, I usually look at what management is saying and what the analysts are saying, and then knock off a few percentage points from those. If consensus is 10%, I'll put it at 7%, a 30% margin of safety. To really understand if the future economics are not just solid, but great, we need to understand what the sustainable competitive advantage of that business is. Warren Buffett calls it an economic moat. What does that business do that makes it virtually untouchable by competitors? I said earlier that a business model must be simple, but should be nearly impossible to duplicate. Visa has built a proprietary transaction network that enables people to transact at lightning fast speed and security. They charge fees to access that network. So many fintech competitors have popped up in the last 15 years, and not a single one has taken market share from Visa. In fact, Visa has co-opted many of them. MSCI has become the world's standard for fund manager and investment portfolio benchmarking. Go look at any non-S&P 500 index fund or ETF and look at what its benchmark is. These index funds must pay MSCI a recurring fee to use it as a benchmark. Once it is a benchmark, it won't change. It is, after all, a benchmark. Adobe and Microsoft have switching costs for their software. Costco leverages its size to be the lowest cost provider. But the economic moat alone is not enough to guarantee great returns. There must be growth. What does that future look like for that particular business? Well, in Visa's case, something like 80% of the world's transactions are done in cash. That's a tremendous amount of white space for Visa to grow into. Index investing is the fastest growing form of equities investing, not just indexing, but more and more niche indexing. Funds are paying MSCI to create new index benchmarks. Also, for the indices managed by MSCI, they receive asset fees as a percent under management. More new investment money flows into index funds than any other form of equities. And Costco has demonstrated it is one of the few U.S. retailers that has been able to replicate its success at an international scale. Walmart and Home Depot have had some success, but mostly in North America and the UK. Many other retailers have flat out failed when they opened stores outside the US, even failing in Canada. Tractor Supply comes to mind there. Costco is in 13 other countries and has plans to expand into many more. These are examples of businesses that meet the 3 criteria for high and growing intrinsic business value. Few businesses can execute on these 3 year in and year out while also staving off the competition. But the ones that do consistently outperform the market, and usually by wide margins, even while trading at PE multiples that seem ridiculously high. As you gain experience over time and come to understand more and more of these characteristics, you'll be able to better identify the true intrinsic value of a business and how to properly assess its potential in the market. Many times, high growth rate inputs into a DCF model are impossible to justify even if the market loves the business, and the reason is sometimes not obvious. These investors know at a subconscious level that the business is missing some characteristic. Management has made dumb capital investments in the past, low ROC, lacks transparency in its reporting, or has changed and is unproven. Maybe the SEC is sniffing around for impropriety. Maybe the future economics of the business are in peril. Software businesses, for example, trade at very high PEs and have wild growth projections. But how many of those will truly fend off competition in this cutthroat industry? What have they demonstrated in the past as an effective economic moat, inoculating it against competitors? Or is it just one in a sea of many others promising great things without a track record? I hope this video helps illuminate the intricacies of intrinsic business value. If you made it this far, thank you for sticking with me. And remember, trying to value a stock is so much more than numbers and a model. I encourage research and understanding in the business itself because after all, that is what we're buying. A business. As always, this is not financial advice. And with that, thank you for watching today's video. And what do you think? I love the feedback, so comment below with your thoughts. Also, please hit that like button. And if you found this info helpful, consider subscribing to the channel and joining our community. Thank you and happy investing.